Hello and welcome everybody to the webinar on ESG as a new reporting standard. This is continuation of the previous webinar we have had earlier this year, taking into account the subjects we collected from previous participants' feedback. The webinar is organized as a part of Microfinance Center activities under SIFTA project. My name is Pavel Kapstorfer. I'm MFC Network and Partnership Manager, and I will moderate this webinar. Today, we will try to share concrete examples of ESG data reporting, how the risks are assessed and can be integrated. We will share a few calculations and how to interpret and use the results, how they might impact the overall performance, but also credibility of the financial service providers. Let me talk now about our housing rules. Our webinar is planned for about 90 minutes. That will include presentations from our expert speakers, few polls, and also we have space for questions and answers. The webinar is going to be recorded. We invite you to keep your cameras on, but please keep your microphones muted. My colleague, Joanna Żukowska, will be assisting you through the chat with any technical issues and make sure our session will go smooth. In case you would like to post any question or comment, please do it via chat or raise your hand through the dashboard under button reactions, and we will invite you to unmute and speak. At the end of the webinar, we would like you to fulfill our survey to evaluate the webinar. And it's going to take only 1 to 2 minutes, and it's very important for us to receive your feedback. The survey will open on your screen when you leave the webinar. And now I have a pleasure to introduce our speakers. For today, Cécile Lapenue, Executive Director of Cerise, French non-profit organization, pioneer in social performance management, in the field already for 25 years. Cécile has long-term experience with inclusive finance, research, and sustainable development. She's also a board member of the SPTF, given that since 2021, both organizations operate under a common strategic plan. Cerise and SPTF are champions of interdependent and complementary assessment tools and products, and they are global leaders in social and environmental performance management. Let me also introduce our second speaker for today, Taras Seri, who is climate finance and also carbon accounting expert from IFC. He has over 20 years of experience, had held various management and advisory positions in reality financial sector companies in North America, Europe, and Central Asia. And over the past 15 years, Taras has supported various renewable energy and climate change mitigation projects with private and also DFI funding. In the last few years, his work focused in developing regulatory framework for climate finance on the side of financial sector regulators. He's also supporting IFC clients to decarbonize their activities and align their operations towards Paris Agreement goals. I would like now to also say a few words about our upcoming events. Social Finance Wipe to be organized on 21st and 22nd November. It's a third edition of MFC online conference with free entry, which will provide fresh perspective of the latest trends in the social economy, including green initiatives, digital innovation, and skills building. We will offer over 30 sessions with more than 40 speakers, influential leaders in social finance, MFI representatives, investors, service providers, thought-provoking think tanks, and inspiring EU-level networks and country-level associations. The registration is already open, and you will find the link also in our chat. Additionally, really good opportunity is the Transform Together Fund. This is call which is already open, and you are able to apply for grant up to 13 November, 17 CET hours. So please feel free to use this opportunity to apply for funding between 20 and 50,000 euro. And you will be able to receive co-financing of your projects in green and digital areas up to 90%, which is very attractive opportunity. For those who don't know yet SIFTA, this is project which brings continuity to EASY Technical Assistance Program, and European Investment Bank under InvestEU Advisory Hub reinforces the European microfinance and social enterprise finance sector and provides support to microfinance and social enterprise finance providers under window social investments and skills. The support is given to tailored trainings, workshops, webinars, peer-to-peer exchanges, study visits, wide range of topics related to financing micro and social enterprises. The project also delivers rating, assessment, and evaluation services provided by MFR. What the SIFTA offering and for who? So this is basically project which is eligible for all EU countries, and the initial budget is available until December 2024. And the beneficiaries, the applicants who are eligible are microfinance providers, such as banks and non-bank microfinance institutions, and also social enterprise finance providers, such as investment funds, impact investors, incubators, accelerators, etc. The technical assistance team, responsible for the market development activities and capacity building services, consists of a consortium, which is led by Frankfurt School of Finance and Management, and its partners, Microfinance Center, the European Microfinance Network, and for rating, assessments, and evaluation services, it is MFR, Microfinance Rating. If you would like to apply for SIFTA projects, please feel free to learn more about the link in the presentation which you are going to receive from us, or also write an email to the stated email sifta@aib.org, where you can basically contact AIB to learn about the next steps. That would be my introduction. And now I would like to give a floor to Cecile to share her presentation and experience. Thank you, Cecile.
Thank you, Pavlov and Joanna, for this opportunity to continue exchanging. I will share my screen, and this webinar is the next step after we started with Nusmir Kajik also in June to present ESG reporting. So today we wanted to go a step further. I will rapidly present Cerise+SPTF for those who did not attend the previous webinar, but really we will focus with Taras on how to report on ESG framework and what does it mean, how to make concrete lessons and improve practices for the financial service provider. So we will share examples of reporting on environmental issues, and Taras will share his experience on GHG emission accounting standards. I will share some insight from what we have learned on the social and governance side, analyzing portfolio quality segregated by gender at the client level, analyzing gender pay gap at the staff level or board gender diversity, As you see, we focus a little bit on gender, but maybe it's in honor of the new Economic Nobel Prize, Claudia Goldin, who is studying women in the workforce. So I think we have data and experience from the financial service provider side to share also and to go a step further in equality in the workforce. So rapidly, if I want to present Cerise+SPTF, you may have known us as Cerise or SPTF. So SPTF has been created in 2005 to develop, maintain universal standards for social and environmental performance management. SPTF managed grant facilities to support implementation. And Cerise has been working since 1998 on supporting financial service providers, social businesses, and investors in implementing social and environmental strategy. We have developed social audit tools, now SPI Online, benchmark of best practices, and building local capacity with a SEPM, Social and Environmental Performance Management network of experts, what we call the SEPM Pro Network. So now we are working, as Pavel said, under the same roof, Cerise+SPTF, to really join forces and continue supporting financial service provider, investor networks, TA provider, researcher, etc. in the social and environmental strategy. So what makes the value of our work is that we really help financial service provider and their stakeholders from setting the standards to demonstrating practices with the standards, learning about the standards, assessing the practices with SPI Online. SPI Online now is a platform with tools to assess, 7 tools, and resources to guide assessment. We guide on practice improvement in client protection and ESG and social performance, and we provide reporting and benchmarking. And we are linked also with certifying organizations such as MFR or MCRED or Inclusion to prove the social and environmental strategy. So here today, we focus more on the tiny Russian doll among our tools, the entry point, the do no harm strategy, and how we can assess and support ESG risk management. So maybe a first poll to see where you stand as practitioners. Have you had to report recently on ESG topics? No, it's not applicable for you. Yes, but just internally to manage social and environmental risks. Yes, for external partners. Yes, and in particular, linked to alignment to the SFDR requirements. Joanna or Pavel, can you launch the poll? Do we have a poll? Yes, perfect. So just to get an idea whether ESG reporting is already applicable for you, not yet or no, and if it is more internal or external. Okay. So let's have people answer. We are.
And maybe to say that, you know, some organizations are reporting internally, but also externally. So it's a multiple choice poll.
Okay.
So feel free, you know, to select all these choices which are applicable.
Okay, so we see that for 1/3 of you, it's not yet directly applicable, or you are not a financial service provider needing to report, so maybe not applicable or not yet. And you, yeah, for 42% of you, you do it for external partners, but also internally a little bit to manage social and environmental risks. And for few of you only, it's directly linked to the EU new regulation on SFDR, Sustainable Finance Disclosure Regulation, which is much discussed on the current days. Okay, great. Thank you very much for your input. So let's go now into the content, just to give you a little bit the framework of the SFDR. But even if you are not linked to the SFDR reporting, this question of ESG reporting and ESG risk management remains something which will become necessary. As we say, women in the workplace, how do we manage gender equality, environmental issues, CO2 emission, biodiversity protection, vulnerability of clients to climate change. We are all facing some risks. So for the SFDR regulation, every fund is classified in Article 6, 8, or 9, depending on how far they want to go in investing in sustainable objectives. So the more you are working with impact investor, the more you will be required also to report. And those, what we have worked with the social investor working group at Cerise+SPTF level is also how to make sense of this reporting. So it's not just a ticking the box exercise, but how to draw from those set of minimum disclosure standards to increase transparency, to prevent greenwashing, but also to manage social and environmental risks at your level as financial service provider, for example. So let's see how it looks like. So the Social Investor Working Group and Cerise+SPTF have been working together for almost 2 years to make sense about the SFDR reporting, and now we can provide concrete examples. But to start with, I'll let the floor to Taras to present and help us understanding greenhouse gas emission accounting standards. So Taras, I stop sharing my screen and I give you the floor for the environmental side of the ESG reporting.
Okay, so give me a second. Let me share the right screen here. Okay.
And feel free to ask any questions also on the chat box.
Yeah. So here we are. So basically, let me really quickly introduce myself a little bit more. So my work in the past 3 years has been really focusing in Central Asia and the Caucasus region and the Middle East, working with a lot of mostly banks, although some banks that have evolved, so to say, from microfinance organizations, where they had, so to say, these new requirements from their core investors. And also because IFC is part of the World Bank Group and is also what is considered to be a DFI, Development Finance Institution. All of us, including EBRD, EIB, and so forth, have specific targets, part of the mutual agreement on the Paris alignment, where all of our investment projects and all the, so to say, financial institutions will have to be Paris aligned. And part of this Paris alignment process is ability to report on your emissions. So this is why it's really relevant. And financially, it's relevant because if you want to attract, so to say, financial resources from the DFIs, you will have to be able to do this. So as we keep going, today we'll basically discuss the real basics of where the stuff is growing from. So once you do this, at least you will be able to trace how the information is coming and where and how the standards were shaped and what you need to look out for. So first of all, what are the greenhouse gases, right? I mean, obviously the gases that we emit that increase the temperature of the Earth. And obviously everybody heard about the carbon dioxide. So this little abbreviation, GWP, is global warming potential, and carbon dioxide is always one. Everything else is relative to carbon dioxide. The next most common gas that we emit is methane. And that has a global warming potential of basically 28. So for 1 kilogram of methane you emit, it's equivalent of emitting 28 kilograms of CO2. The next very potent gas is nitrous oxide. In practice, maybe you know it is laughing gas, something that comes in the hospitals where they try to put you under narcosis. A lot of times they use nitrous oxide. But in practice, most of this emission comes from the farms and so forth. And 1 kilogram of nitrous oxide has the same effect as 272 kilograms of CO2. And then we get into the wonderful, they call it gases, but it's really a group, laundry list of about 230 compounds, which are called hydrofluorocarbons and perfluorinated compounds. And in practice, you see those usually as refrigerants in air conditioning systems or aerosols or chemical process catalyzers and so forth. And depending on which specific formulation it is, 1 kilogram of that formulation can be as high as 12 tons of CO2. So even though you might be emitting a very small amount, in reality, the warming potential is quite significant. So how did all of this, so to say, get started? So back in 1984, there was a Geneva Protocol on financing long-term monitoring and evaluation of air pollutants in Europe. And this protocol has really kind of set the stage for everything else that followed later. And it didn't just cover Europe, but also covered parts of North America and Central Asia. So this was kind of like that, humanity's first attempt to actually do something about it. And then we had, and I'm kind of skipping here, Montreal Protocol in 1987. And the reason Montreal Protocol is relevant is because some of these PFCs and CFCs were reacting with ozone, and ozone is basically the same thing as oxygen, but just has 3 molecules of oxygen, 3 atoms of oxygen in 1 molecule, and it protects our world from UV radiation from outer space. So we really realized that, we don't want to have destruction of ozone. So everybody kind of agreed that we're going to try to limit the emissions of gases that were part of Montreal Protocol, which have the ozone depletion potential. So after the Geneva Protocol, there was Montreal Protocol. And then, of course, most of you probably heard of Kyoto Protocol in 1995. And that allowed nations to trade their emission credits. So, for example, a nation like Japan, who would emit quite a lot, they would do some kind of offsets in the countries which had less emissions than they had back in 1990. So the baseline for Kyoto Protocol was 1990, and that was transferred over to Paris Agreement as well. So, for example, Japan would finance some kind of projects in Ukraine, of all places, so that they can take some of these credits that Ukraine was not emitting back in 1990 and transfer them to themselves. But as the system was kind of developing, people realized that it's not really effective. And the next thing we had was this Paris Agreement that everybody heard of. And the Paris Agreement, officially known as UNFCCC, or United Nations Framework Convention on Climate Change, was the next attempt to really try to limit our emissions of these greenhouse gases. And the core theme of UNFCCC is really to limit the temperature rise to 2 degrees or less. And the way UNFCCC is organized, there is a special scientific body composed of World Meteorological Organization and United Nations Environmental Program, which sets the standards of how do we count how much global warming potential a specific chemical formulation has. And all of this is, again, is under IPCC, which is Intergovernmental Panel on Climate Change. So if we're kind of clear on this one, let's go towards commercial site standards. So basically, all of this is relevant on the government level. When we go on towards commercial sector, actually, I've got a poll. So let's pause here, and you guys should answer this one. And there was a hint, so if everybody listened carefully, we would get 100% right answers. Pavel, if you may.
Can you perhaps read through the poll to
Sure,
everybody understands what it is about, and then I will launch it. Thank you.
Okay, great. So the core theme of Paris Agreement is on how to transfer money between governments, to keep global average temperature rise below 2 degrees Celsius, to introduce the ESG standards, and to develop carbon accounting rules. Which one of these is correct? So far, so good.
Okay, it seems like the number of replies is okay. Some are coming still, so let's wait last 10 seconds, and then we end up the poll and publish the results. Okay, let's share the results with you.
So yeah, the agreement is really about keeping the global temperature rise below degrees Celsius. Everything else is kind of supporting tools, and it's not really in the regulation. So if you really look at the core text of Paris Agreement, is that all the nations agree that they will somehow manage to keep the emissions low enough that it'll be less than 2, ideally 1.5. Of course, we'll see how that goes. And for that, we'll probably need the ESG standards and accounting rules, but again. Okay, so let's move on. Currently, for commercial sector, we have the GHG protocol, which is the oldest and the most mature, and it's not a single standard. It's actually a group of standards and guidances that if you go to their website, ghgprotocol.com, you will see there's multiple ones. The ones that are most relevant is the corporate standard, which covers typically your scope 1 and scope 2. And of course, there's some clarification to the GHG protocol and scope 2 guidance, because in the initial text, only electricity was part of scope 2. But then as some more use cases started coming around, you also have centralized heating and centralized energy purchases in terms of steam or something else coming in scope 2 as well. And then you have the corporate value chain, which is actually called scope 3 standard. And this is really what covers your indirect emissions. And we'll discuss this a bit in more detail. And then around 2016, there was GRI 305. And it's a set of standards within the GRI framework, which really reference GHG protocol, but for GRI standard users. So if you read through the 305 standard, you'll see that most of the categories they reference are according to a GHG protocol. And then as we were working more in the financial sector, the initial guidance from corporate value chain standard was not clear enough. So we had a development of what PCAF, and it's Partnership for Carbon Accounting Financials, which focuses solely on portfolio emissions, which are part of category 15 under scope 3 under GHG protocol. And there you have 3 substandards, the financed emissions, which is PCAF-A, and it's already in a second version. There was one initially in 2020, and now in 2022, there was an update. Then there is a facilitated emissions, and it's still under development, but it's really for investment companies. And then there is insurance associated emissions, also released in 2022. And again, it's more of how would you show your scope 3 if you're an insurance company. And then we also have a fairly old standard. Again, it has been updated recently, but again, ISO 14064 is very, very similar to GHG protocol or GRI 305. The only difference that kind of likes to use its ISO speak, it's also paid standards. So if all the standards above here are free to read, for ISO, you have to pay, I think it's, if you remember, it's cheaper, but if you're off the street, you have to pay, I think, 1,100 Swiss francs to access a standard. The 1064, it gives you scope 1, scope 2, and scope 3. The only substantial difference between them is that the categories for scope 3 are defined differently in GHG protocol and ISO 1064. And the reason this is important is for those of you who are going to be in the EU or working with EU clients, the last one on the list here, the EU SRS E1, which is still kind of in the draft, at least online, it is already referencing this note that the categories should be according to the GHG protocol. So if you are using ISO 1064, you have to adjust the scope 3 categories. And then there is IFRS S2, which just been released a few months ago. And it's relevant for those who will be filing reports under the IFRS framework, both your financial and non-financial disclosures. And in IFRS S2, they're making a reference to following GHG protocol standards for all of your reporting. So for scope 1 and 2, you'll be using GHG corporate standard, and for scope 3, you'll be using corporate value chain. So let's go to the next one. So how do we measure GHG? So there are 2 ways. One is metrological, where you have literally special instruments attached to a smokestack or some kind of process exit thing, somewhere you have emissions, and there are meters which tell you how much CO2, how much nitrous oxide, how much methane you're emitting. And those things exist, but they're usually for large factories. In most of your clients in microfinance, you'll never see those. And the rest of the world kind of works in what we call accounting method, right? So you basically take the amount of fossil fuels you consume, or the amount of, so to say, CFCs and PFCs that you emit, and then you multiply it by some kind of coefficient. So this is called the accounting based. And as I said, probably 90% of the global inventories are on the accounting method. So then the question is, okay, so you understand the core methods, right? Next question is like, how do you define the boundaries of organization, right? Like, for example, I can be, Trasir Inc., and then I might be a subsidiary. How do I define who gets into my inventory? And to define this, you usually use three approaches, right? By ownership or control. So there's an equity share approach. So if you have any kind of equity investment in any kind of other company, all of their emissions multiplied by the ratio of your investment in the company are your emissions. Now this works for some cases, but in most cases, it's very, very difficult. So then we had try to find better approach. And there are two. The operational control is if your subsidiary looks for you for operational procedures. So if you as a mother company give operational procedures to your subsidiary, you have operational control, and that means that you have to include their activities in your emissions. Or if you are, and this is most common, using the financial control or financial consolidation rules, anybody who falls into your financial statements, their emissions are part of your emissions. So going to the next one, we get to the scopes. So the scopes are divided by, a lot of people have mentioned this in the previous webinar as well. We got the scope 1, which is direct, scope 2 and indirect, and scope 3 is a value chain. So how do we tell scope 1 and scope 2? Scope 1 means that any source of emissions which you control, which means you can turn it on and turn it off, and that source of emissions consumes directly your fossil fuels, that's your scope 1. So if you have a gas boiler in your premises and you can turn it on, turn it off, that's your scope 1. Cars that you can drive, scope 1, again, even if they're rented. If you rent a car, but you fill it up, you basically decide how much it drives, it's your scope 1. The indirect is energy that you consume that is generated by somebody else. So clearest case is, again, electricity. So if you buy electricity from somewhere, unless you generate that electricity on site, and that's your scope 1. But if you buy it from a utility company, that's your scope 2. So you control the amount of energy you use, but you don't control how it's generated. That's kind of the litmus test there. And for scope 3, you have basically everything that's not under your control, but is influenced by you. And here we have a very clear, although it's not very visible from the slide probably, but the first category is purchased goods and services. So all of your procurement stuff, if you buy a table for your office, or if you buy stationery paper, whatever, all of this has indirect emissions. And ideally, you would get some kind of certificate of emissions for that particular item that you procure, and then you would put it in your emissions. Then you have the capital goods. And the capital goods are something that you construct. So if you want to build an office or something like that, that comes in. Then there's fuel and energy related activities, but that's mostly for manufacturers. For the banking sector, you rarely see this. Transportation and distribution. Again, if you have some bulky items you constantly buy, you would probably put this in here. And then you have waste and other operations. Then you have the business travel, and then employee commuting is also part of this. And then if you're leasing offices, right? So for example, you're in a business center and you don't really pay directly for energy, you just pay some kind of standard rental fee. The emissions from that office would be in here. And then you have sort of say the downstream. So it basically happens after the stuff leaves from the factory or from the company. So again, transportation. So basically processing, and this is mostly for industry, again, not very relevant for banking sector. If you are a car manufacturer and you sell cars which emit CO2, the customer's use of your products over the lifetime is also your scope 3 downstream activity. The end of life recycling or disposal is also part of your downstream. Leased assets here means that if you are in the business of leasing real estate, this is where your emissions of your customers will come in. Franchises, and it's fairly straightforward. And the most important category for us is this category 15 investments. And this is where all of your customers' financed emissions come from. So if you give a loan to somebody, what happens in a very simple case is their scope 1 and scope 2 come in the share of your investment and become your scope 3 category 15. That's the easiest way to think about it. So let's see if we manage to get anything out of this. So basically the question here is, if you have done scope 1 and scope 2 reporting, how did you develop organizational boundary map? So A, you didn't bother. And if you did you use equity share, operational control, or financial control? Well, if you can watch that. Oh.
Yeah, it should be on the screen now. And yeah, while the people are answering, maybe Taras, a few words about this organizational boundary map.
Yeah, so basically what I see a lot of times, and with our clients and also with some of clients outside of IFC, is that a lot of people do report their emissions on their sustainability reports. So when you come in and ask them, it's like, guys, did you really, include all of your subsidiaries and so forth? A lot of times this is where the error comes in. So there is everybody just reports it for themselves, even though according to the standards, they have to report it according to a certain hierarchy. Wow, okay, so it's actually operational control people. Okay, that's good. So really, this is like the first step in any kind of emission reporting. You have to set the boundaries of what you will calculate. And again, this is fairly well prescribed in a GHG protocol. But one little, so to say, life hack is that if you are planning to use PCAF, PCAF specifically excludes equity share approach, because then it becomes somewhat difficult for organizations to quantify. So they recommend that you either stick with an operational control or financial control approach, and this way it'll be easier. So if you're planning to use PCAF in addition to GHG protocol, stick with the later two. So operational control or financial control. So most people haven't done it yet. So this is something to think about. And again, this is the easiest step. Like realistically, if you're going to do it, it'll take your team probably like maybe a few days to really come up with something, and then probably another month to approve it with the supervisory board or operational board, depending how your corporate governance is structured. But as I said, usually when we start, most our clients are able to do it within a month for sure. So I guess we can move on. Okay. So realistically, because all of this has potential to be fairly expensive, why do you even bother, right? So biggest issue becomes is you cannot control what you cannot measure. And if you're trying to set targets or anything else like that, you need to really be able to do that. The second one is, especially now, it really becomes a business opportunity. Most banks we work with really see the emergence of new technologies, especially in the markets where cost of energy is fairly high. And really there's competition for financing of these and certain things. So the guys who were there first, who are able to quantify it, who are able to develop these green projects and so forth, they really are starting to get ahead of the market. And the third, of course, which is becoming even more relevant, the fact that access to finance is becoming an issue. And the access to finance is really relevant because, if you're planning to invest or get investments from IFC, EBRD, and so forth, you really have to play the game. And then, of course, especially for those who are in European side, reporting and compliance with ESDFR and so forth has become really relevant from the years coming forward. So, going down. How do we calculate the portfolio emissions? So we basically take the value of an asset. Let's say a car is $50,000, right? So we put this in the denominator. we take the amount of loan, let's say 50% or 25,000 that goes on top, and then we calculate the asset emissions. And this is where it gets kind of a bit hairy and it's not really clear from all the standards. So if we look at GHG protocol corporate value chain, the asset emissions are your life cycle emissions. So ideally, if you're, for example, buying a Tesla, you have to get the total emissions from Tesla, how much it is to manufacture, then actual in-use emissions, and then the utilization emissions. And then when you basically put this in, and then you sum all of your individual loans where you have a clear use of proceeds, and you move forward. So let's do another poll real quick. So the scope 3 category, scope 3 emissions, which category is the one that gets our portfolio emissions? Is it purchased goods? Is it use of products? Or is it investments? Better answers, come on, more. Only 35% of you. It's 1 out of 3, 30%.
Well, I can relaunch, no problem, but I saw that it's not moving for some time, so I decided to stop it.
Okay, so basically it's the last one, it's category 15 investments. This is really where your portfolio emissions are. Because I'll scroll back in the presentation, just really quickly show you. It's over here. This is where your portfolio, and this is for most of financial institutions. This is really the largest chunk of emissions that where it comes in. Your operational stuff is fairly small, but this is really where most of your, so to say, scope 3 emissions will reside. Okay. So real quick, short departure on data quality. So there is a thing in carbon accounting called uncertainty principle, right? And ideally, you wanted to keep it to less than 10%, but in many cases you can't. So sometimes if you look even at UN reporting, there would be cases where the uncertainty would be like 100 to 100%, which I guess is okay for government reporting. When we get into financial and where there's actually money attached, even 10% is high. But right now, we have what we have, so we kind of have to deal with it. So ideally, the most accurate readings are your direct meter readings. And the second one, and this is mostly laid out in PCAF, if you read through it, they have similar structure. You have third-party verified energy use, which is basically what you calculated already. And there's some kind of third-party assurance saying that, we really agree with the calculations they did. For your practical use, you'll probably be working with calculated energy use or physical activity-based emissions or economic activity-based emissions. And let me tell you the difference. So calculated energy use is when you take the amount of fuel, for example, your cash trucks consume, and you multiply it by a coefficient. And the coefficients vary on 3 tiers. So there's tier 1, which is the global one, and I'll show you this one. And then there's regional emission factors, tier 2. And for those, again, who are in the EU, you probably have these for sure. Those of us in the rest of the world, you probably don't have anything. And then you have local emission factor databases. And this is really where the government has really stepped up and developed really like localized within a city or even maybe like a smaller region, and they give you certain data. And again, some countries are fairly good at this, including EU. But for most practical, we usually either go with a global or regional if it's available. And then you have physical activity-based emissions. So it's emission per unit of output. So let's say your customer's producing cell phones. And basically, that's a cell phone somewhere. And for each specific cell phone, let's say there's some kind of number globally agreed on, that that cell phone roughly will generate so much kilograms of CO2 in production. So then you take your customer's output and you multiply it times that coefficient and you get some kind of number. This is a little bit better quality than economic activity-based emission, is something that was shown in the previous presentation, where you have the NSA codes or economic activity codes if you don't use NSA system. And you have somebody, either industry data or government data, which provides you, so to say, inputs of how much a dollar of revenue in that economic activity generates. And again, this is typically when you look at, so to say, banks reporting under PCAF, their data quality is like 405, or 4.5, 4.2, or something like that. So most of the banks right now are really calculating here. But if you're a microfinance, and if you build your IT systems correctly, you can really quickly jump over here to third-party verified or calculated energy use, because with banks, the tenor of loans sometimes is 10, 20 years and so forth. So for them, even if they introduce any changes until they totally upgrade their portfolio, it's a couple of decades. In the microfinance, you usually have a rollover about maximum 2 to 3 years of most of your portfolio. So if you build in the systems and you collect the information correctly, you can actually fairly quickly achieve high levels of data quality in your portfolio. And also when you're building your IT systems, and the reason why I say building IT systems is most clients I will work with, we advise them not to use calculators, not to use third-party systems, but really start integrating all of this GHG calculation in their credit process, in their underwriting, into their core banking or the front office, whatever is easier for them to integrate into. Because you really don't want your green loans or climate loans to be any more difficult than regular loans. So if you build in as much of the automated data collection, automated data reporting in a system, the easier it becomes. And as you're building the system, you have to keep in mind that all of this information has a tendency to change. So here is a good table showing this 100-year horizon global warming potentials for most gases. And as you can see, methane has grown from 21 to 28, and the nitrous oxide has actually been reduced from 310 to 272. So what happens is, if you read this, so to say, preambles to most standards, they say, we usually try to set them up to be consistent for the organization from year to year, but not to be consistent between different organizations. What's really happening right now with IFRS S2, with the EU guidance and so forth, is that the regulators are trying to make the data compatible across different organizations. So there is actually, especially with the regulators I'm working with, there is a systemic approach to giving standardized coefficients, to giving standardized guidance, so that when the bank goes to calculate and it sees this uncertainty, and I'll show you these various values, you really stick with the same data, so that your neighbor bank is, or neighbor microfinance is using the same data. So we can really see if anybody's becoming more efficient in terms of environment. So this is that story. And now I'll kind of really quickly go through and maybe jump between some slides. How do we calculate? So first of all, we really need to get the emissions calculator. And as you see, we have a separate emission calculator for carbon dioxide, for methane, for nitrous oxide, and so forth. But in reality, what most banks and most organizations need is the single coefficient, which is called CO2 equivalent. And again, if you look here, we're using the maximum value that comes from this reference book. And if you guys want to see the reference book, I'll try to share what it looks like. Okay, so this is basically, I'm going to switch screens here just for a second. So this is the IPCC website that gives you guidance for greenhouse inventories. And if you click here, you get a bunch of these wonderful books here. The ones that you most likely will need is energy. And we go into energy here, and you have a couple of things. So first of all, stationary combustion. So stationary combustion is anything that doesn't move, and mobile combustion is everything that moves. And when we say a portable generator, that's still stationary combustion, even though you can technically move it. So for example, let's take mobile combustion. You can get this lovely PDF here. And as you kind of scroll down through, you get a table. And you see it gives you road transport default CO2 emission factors and uncertainty rates. So the default one, for example, for gasoline is 69,300, and this is kilograms per terajoule of energy. And we'll get to that a little bit later. But the upper is 73 and the lower is 67.5. So this is roughly about 5% plus minus. On some other things, as we can show you later if you're interested, sometimes the uncertainty range is up to 50% or more. So what we usually give guidance to our clients is that use the upper unless you really have some issues. So this way, you report the maximum potential, and then nobody will complain that you're under reporting. But sometimes certain projects will actually fail. So in many cases, we actually had to resort to default values to justify some projects. So this is just kind of the guidance. So you have one for here for CO2, and then you also have separate one for CH4 and for nitrous oxide. And again, you have to add all of these to get the CO2 equivalent. And once you get the CO2 equivalent, then you get the proper result. So going back to our presentation. So here we calculated the CO2 equivalent based on the data, and we got the kilograms of terajoules. Okay, great. So how do we convert it to something usable, right? Apologies. So we have energy density of 1 liter. This is a physical, so basically how much energy equivalent is in a liter. And this is also kind of highly specific to a specific refinery. But in this case, we found fairly good data from the Irish Environmental Agency. And if you go to their website, according to this link, you get some numbers. So for diesel, it's 36.6. And for gasoline, it's roughly 33 megajoules in 1 liter. So then we need to convert our terajoules, which is million megajoules, to liters. And we get basically in 1 terajoule, we get 27 tons of diesel and 30 tons of gasoline. And once we do this, so we basically divide that by that, and we get the emission factor, which is 274 for diesel and 241 for gasoline. That's kilograms per liter. So if you burn 1 liter of diesel, you get 2.74 kilograms of CO2. And if you burn 1 kilogram of gasoline, you get 2.41 kilograms of CO2. And then after you have this, all you do is you take your annual fuel purchases. So in this case, it was 1.5 tons from in diesel and 2 tons of gasoline. We multiply it and you get the CO2 emissions in kilograms, and then just divide that by 1,000, you get your emissions in tons. And this would go in your scope 1 emissions. And then basically, for example, that's pretty much it. But if you guys want, I can show you really quickly how the banks report their scope 1 and scope 2 and so forth. So let me switch over a slide here. This one, I kind of like. It's a very pretty report. And go to page 46. Where we start. So basically, they give a little bit of an introduction about their targets, why they're doing this, and they go here. And then on the high level, here they show the scope 1 and 2 and scope 3, so total emissions, and so to say their energy consumption. But they also, if you read through this, they show that they try to purchase renewable energy and so forth. And if we want to get into details, here they describe how they arrive in the calculation. So they show energy consumption between the years. See, they're buying electricity and sort of say other fuels, and they're getting sort of same matrix, but this is more for their ESG reporting of energy intensity per full-time employee. And then they're showing you scope 1, right? There's your scope 2, scope 3, portfolio, business travel, purchase goods, greenhouse, and so forth. So like basically like this, what we are doing with some of the regulators.
Tara, sorry, what type of organization is this report? Sorry, I missed it.
Sorry, it's Julius Baer. It's I think bank out of Luxembourg.
Okay.
Yeah. So, yeah. So, and you can see actually ProCredit they have a very nice disclosure standard, but it's like an Excel. And if you go to the ProCredit Sustainability Report for 2022, and you can download an Excel there, there's also very, very detailed information. And because they're global, you can see also regional breakdown and so forth. But these guys, it's a fairly small bank. Hopefully you won't blame me for it, but compared to some of the other ones. And they do a very, very clear job and a very simple way of showing how they're reporting what and what categories and so forth. Now that we're, those of you who are going to be reporting under the EU guidance, this ESRS E2, what you really want to look at is the standard forms, because I've now noticed that some of the disclosure forms are guided by, so to say, requirements of the regulator. So if you have EU requirements, I would reference the E2 form, you know, like what specific fields and forms you have to fill out there. And then you will basically go along that route. For most of the banks which don't really have it, we usually try to align them with scope 1, kind of list the categories, scope 2, list exactly the categories. And also for scope 3, category 15, we also like to include a matrix of how much of your portfolio has defined use of funds. Because we had some banks which had over 80% of their portfolio where they didn't know where the money went. So for them, trying to do a meaningful GHG inventory on their portfolio is very difficult. Some banks in certain countries have over 90%. So for them, this job was fairly easy. So for example, if you're giving out credits to your clients where it's just, I don't know, here's $1,000, just pay it back in 3 months, you will have difficult time calculating this. If you will give for specific purposes, or at least you track what the people are spending the money on, this is irrelevant. Also, just one more sort of say parting thought on all of this is that really to integrate all of this GHG reporting into the IT systems to make it automated, to make it easy, it takes a few years. I mean, for a scope 1 and 2, the fastest I had a bank do it was in 3 months. On average, it takes 6 to a year between all of their approvals, collecting, For scope 3, the guys who are in the EU, because the data is so much more available, still at least a year project. For those who are outside of EU, you first of all have to build a relationship with your partners so you can get the data. And then once you're able to get the data, then you have to sort of say produce it and so forth. If you're just trying to do a high level economic category classification, which again in some places is also difficult, but if you're just doing a high level report, you can probably get 15 people somewhere department to sit down and do this calculation in a meaningful fashion and produce it. But if you're really trying to integrate this into the system so it's done automatically, it's a at least 2 or 3 year project. And if you have to report by the end of 2027, time is ticking.
Taras, we receive a question from Meriton. Are there tools that can do this calculation automatically, or do we have to do this manually?
No. Please don't do it manually. Now, again, ideally, what you want to do is you want to build this process in your core banking or whatever IT system used for loan processing. Because, for example, if you're doing a lot of consumer goods financing and you're doing it in EU, there's actually a website right now that will give you energy label data, energy consumption data for each particular item you want to finance. So for a washing machine, for a fridge, and so forth, you can just plug into it. If you're outside of EU, what I would be advising people to do is to get to the importers, distributors of this, whatever credit lines you have, whatever goods you're planning to finance, get to them, try to get them the data so they supply you the data, and then try to plug it in at least once a year, updates, whatever, or have them plug it into your database so that when you come in to issue credit, if you have an app or something, you just scan the item, you get the details of what it is, and then you issue your credit and basically done seamlessly. So definitely don't try to do this by hand. You will shoot yourself and everybody else will shoot you. But if you want, so to say, high level, you can go to PCAF, sign up for their commitment. They do provide you a high level global database of coefficients and stuff like that. If you're in the EU, I think, I don't know whoever was a presenter in previous webinar, they already show that there's a website that gives you, so to say, based on SA code, some kind of emission coefficient, so you can work from there. So it really depends on which region you focus on and how exactly you finance. And also just really quick one, for carbon accounting, it's really totally irrelevant if you use a green loan or brown loan or something else like that. You just have to literally count everything. For green finance, you know, the reductions and so forth will come through the taxonomy alignment and so forth. So you have to kind of play with those additional terms there. So it's just really for carbon accounting, it really doesn't care. Green, blue, purple, brown, everything has to be accounted for. If you're doing green and GHG reductions and so forth, that's a separate conversation we can have next time.
Thank you, Taras. Do we have any other questions? Was it clear what Taras tried to share with you? Feel free. I mean, there is a lot of technical terms and processes involved. So, and my understanding is that we have a number of participants who are still at the very beginning of tracking this information or planning. So, yeah. Feel free to ask the questions. I mean, given that has made you know, so many you know, assignments already, you know, so yeah, he has that experience, you know, how and what the organizations are struggling with. So maybe Taras, you know, if there is anything specific or concrete you would advise in addition, based on your experience.
Okay,
Well,
yeah.
maybe Taras, just do we have some type of benchmarks or things like this to make sure that the data that we see are meaningful? So, for example, here you say emission CO2 equivalent 4 tons of CO2 for diesel or gasoline, but by size of organization or by type of organization, do you have some ranges of data which make sense and those who are really out of who are not meaningful?
Honestly, at this point of the sort of say global development, we really don't, because we're trying to teach people how to do it. I mean, honestly, I mean, PCAF, which so far I think has 300 banks. If you really look at it, the ones who are actually doing it properly is maybe 20, 30, I mean, huge, big corporate banks who are doing it. And again, if you look at their data quality, again, it's 4 or 5 at the best. So at this point, it's a very fresh field. And what was really interesting is before it was mostly like in green finance, you were doing these calculations. But now, as the sort of say global regulators are really starting to push this, and literally in the past 2 years, everybody kind of woke up. I mean, the IFRS woke up, EU woke up, even the US is waking up, as bizarre as it sounds. I mean, and if you look at sort of say neighboring countries in Central Asia, for example, even Chinese investors are asking banks to follow European or American best practice, which is like unheard of, but it's happening. So this is why it's too early, but the ones who have started on this path, it's easier for them. And again, you know, in most of my cases, for example, I'm working right now on the project in Kazakhstan. In about 1.5 years, banks will have to be reporting. Then it will come down to the microfinance organizations. So it's happening. It's not a matter of if, it's a matter of when. And like I said, because the process takes, you know, years, literally years, the faster you start, the cheaper it will be.
Okay, we have another question from Eritan. Are the emissions of our portfolio calculated based on their investments? Example, if they purchase a machine, the CO2 used to produce, or based on activity of their business, like their energy consumption, etc.
Okay, if you're financing credit line, you would use the industry, because unless you know, it's really hard to really follow and have the calculation. I mean, the customer will probably kill you. But if you're financing a specific asset, then it's the asset emissions. So you really have to look at what is the loan structure, how you're doing it, and so forth. For credit line, as I said, for all practical purposes, we try to follow the economic activity. Unless the customer is so savvy, they can actually tell you, listen, I got so many solar panels coming in, here's their CO2, da, 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 da. But again, in practice, that's winning the lottery.
Okay, thank you. Another question from Isabella. What would be a good approach for factoring companies?
Okay, you would probably follow the bond guidance. So you take your asset-backed securities. You would have some kind of, let's assume you have a portfolio of green, I don't know, retail goods that follow a EU taxonomy. On that portfolio, you would have some kind of emissions. Then you would try to either do an ABS on it, or you would set it as a green bond, and that bond would have an emission, or ABS would have an emission factor attached. Did it help?
Yeah, I mean, if Isabella, it is clear or sufficient. Yeah, thanks. All right. Okay, she confirmed. So Taras, if okay, so there is another question. Will there be a third-party provider available to do all these measurements? Or do all FIs need to develop their own in-house capacity for measuring
Okay,
GHG?
you don't need, this is going to sound like heresy. You shouldn't develop capacity for measuring. You should develop capacity to verify whether or not the customers are really messing with you. But realistically, if you are to do this correctly, you would have customers provide this information as part of the regular loan process. Or if we're talking about retail for microfinance, you would have some partner. Again, like if you're in the EU, for most appliances, I can later look up the link I can share with Pavel. There's a website, you literally just, and there's actually open API, you plug into it, all of your consumer goods for EU market, EU supply chains, they're already available. So all you do is just, if you want to issue a loan for, I don't know, for microwave or something, you would be able to get that data. For those who are outside of EU, it's really figuring out how you can find the right partners. And I'm talking about business partners, because usually it's also a business opportunity that can give this to you. Honestly, right now in 3 countries, we're still trying to figure out how to do this on a national level, but there's government support. And if you're going to try to do this on your own, I'd probably say initially stick with high-level economic activity-based data until you're able to build this capacity with partners or whoever's going to be supplier. Because typically the argument we make when we come into a particular country, there would be a handful of distributors controlling, I don't know, selling Samsung, I don't know, Garenia, something else. And we tell them, listen, we're willing to provide you with green loans, but you have to help our banks kind of get this data. And usually manufacturers already have this data available. The issue is that if it's EU supply chain, they have to automatically report it to European Commission or whatever structures are responsible for it. If you are outside of EU supply chain, then you have models that don't necessarily match. So then there's a sort of say concerted push from the distributor saying, hey, dear manufacturer, please give me this information because the bank is asking. And then they see, okay, yeah, for us it's useful because we can sell more, sort of say, green appliances, So then they come in and they help. So it's really more of like a relationship. Who will give you the data? I mean, there are a bunch of companies right now providing what they call high-level coefficients, but realistically, most of stuff is coming from UN databases. So if you really spend the time, you can save yourself, I don't know, a couple $1,000s a year just on the subscription fees. But if you really want to build the quality stuff, because this data comes in all the time, you want to build in your IT system some kind of API so you can have other interested parties fill it. I mean, a really good example is actually EBRD's Green Technology Selector. I don't know if you guys have seen this. So there is actually a website, and it's somewhat global, where EBRD has done the screening and the suppliers can apply to put in their components into this database so that will qualify for green financing. And over there, a lot of this information is already available. So those of our clients who work with EBRD as well as with us, we say, okay, guys, go to the Green Technology Selector, talk to those suppliers, get that information from them, put it into your system, go report. What we advise the banks, and I guess in this case, microfinance organizations, is not to do it yourself, but develop the process so that interested parties are participating.
And there has been additional question which was stating whether the collected information are anyhow part of verification or audit.
Honestly, I don't think the audit companies know what the heck they're doing yet. The big four and so forth. So I think maybe in 10 years, there will be. Right now, basically anything that looks reasonable is good enough. But as I said, as I showed you right now, even within the official UN data, you saw the ranges. And if you go in some other sources like biomass or something else, I mean, the spread is 120%. So as, for example, from the risk perspective, we say, dear bank, don't take that risk upon yourself. Try to get third party to give you the data, say where you got it from. And then if anything comes in, you can say, hey, I mean, obviously you don't want to be playing, you could get in trouble for greenwashing, but if you have honest attempt to do this correctly, nobody will blame.
Okay, we have additional questions coming in. So how could we know finance emissions linked with PCAF in Scope 3 investment based on each industry?
So basically, PCAF will give you a coefficient for X number of financing or X number of revenue for a particular industry. So you would go to a client and say, hey, what's your revenue? And he's going to say, okay, this is, and you provided him a credit line. So you would take your chunk of his revenue, assign it to yourself by some kind of coefficient, take that coefficient from PCAF, multiply the result. It's very similar to what was presented last time. So you have, your activity, you have some kind of ratio of your financing in that revenue where you arrive at it. And if it's an asset, it's fairly easy.
Okay, thank you. Another question, I didn't manage to find information on how much CO2 is produced per kilowatt hour, and the company does not have a report on that either. So is it possible to use an average, for example, average CO2 per kilowatt hour? A coal plant is 950 grams per CO2, according to some research I did. Is this average acceptable for calculations? Are they considered realistic?
Okay, I got a life hack. Can you give me the country where it was from? Just, it'll be easier. I'll show you exactly how to do it.
All right. Kosovo.
Kosovo, okay, let me see. It should be available. Okay, there's a wonderful organization called IRENA, International Renewable Energy Association. And I'll try to share if it'll let me. Give me a second, I have to drag it this way.
Okay, let's after you share.
No, I'm almost there. Just hang with me. 1 second.
Yeah, no, I just wanted to ask other participants to hold on with their questions.
If you guys can see the screen, there is IRENA, and they have reports on all countries. So over there, they usually try to publish. This is actually not a very good report. They usually try to give you emission coefficient for the country's grid. Let's see if it's here. Okay, it's not really working well, but go look at the IRENA reports. They have usually country profiles for most of the countries. These are some of the other presentations. Those will give you the grid emission factor, and that's fairly reliable one, unless you can get it directly from the generating company. A worst case scenario, if you cannot find either of the other ones, borrow the neighbors. So Albania or whoever else.
Okay, Taras, thank you very much. For your presentation and all the interesting response to the questions. Let's proceed with Cecile. With the rest of her presentation input she wants to give us on social and governance indicators, and then if we still have remaining time after her presentation, perhaps we give still a chance for the rest of the questions.
Yes, thank you very much, Taras. I think it's great, very concrete, and really in line with what we have discussed also with Cerise+SPTF and the Social Investor Working Group and the financial service providers on how to report those fancy calculations. So on the SPA online audit tools, for example, we say that it will be mostly calculated with proxy providers. So we have the space to put scope 1, scope 2, scope 3 for each financial service provider, but we propose to the financial service provider or their investors when they come for due diligence or monitoring to better calculate the loan portfolio by sector, or not to calculate, but to provide the loan portfolio by sector based on an AC segmentation, so that at least we can have the economic activities from the portfolio for the scope 3, and then it's provided to data provider, proxy provider, like the joint impact model or impact institute or other calculation that you have, or tools that you can provide, that you shared also, Taras, so that, okay, at least we have very clear portfolio segmentation, so that we can also link this to risk management. So we link all those activities to IFC or FMO fact sheet on risk management. So if you are investing in agriculture, in growing crop, you can also see, as a financial service provider, as how you have to manage risks. And on the other hand, you can provide this information for proxy providers to calculate your scope 3 emission, and see where you stand in terms in the value chain on CO2 equivalent calculation. So that's great to hear, and nice to also have very concrete examples on how it is calculated and how it looks like, because sometimes we were a little bit lost on which type of figure we should have on scope 1, 2, 3. So that's great to have those examples. So now if we come to the social side of the ESG reporting, we wanted to share also some examples on how we have been working with financial providers and investors on reporting on those aspects. So for example, on the SFDR framework, the principal adverse impact 10 and 11 request financial service provider and investor to identify whether there are risks of violation of UN Global Compact principles or other guidelines. And so identify whether there are sanctions or non-monetary punishment related to business practices against usury law or consumer protection, non-compliance with labor law, funding activities damaging the environment, tax evasion, avoidance, anti-money laundering. So this has been also integrated in the social audit tools, so that the financial service provider can show how they have processed, which type of mechanisms they have to ensure compliance with those minimum standards of do no significant harm. So that's one of the aspects that the financial service provider should provide, and provide then to their investors for reporting at the portfolio level. So for any financial service provider, they have to take this into account, how they comply with national laws, how they reduce damage on the environment. And when we are talking about financial inclusion, of course, we include in the social aspect, not just the decent work condition and protection against corruption, for example, but also a minimum set of indicators for client protection. We know that granting loans, specifically when we reach vulnerable population, as a risk for clients. In particular, we as financial service provider and investor have to prevent over-indebtedness, be transparent on terms and conditions of the loans and the financial products, and treat clients fairly, in particular when it comes to repayment. So financial service providers have to adapt to the regulation. There are regulators that have often adopted client protection standards, especially around clients' complaints or defaults or protests, and that becomes a standard. So to comply with the regulation, financial service providers have to comply with client protection. But for sure, there is a business case for the financial service provider to protect their clients and to make sure that they have loyal and satisfied clients. So that's something that is an add-on compared to the classical ESG framework. On the social side, there is not specifically a lot on client protection. On the financial inclusion sector, we have a lot, and with a long history of support to client protection. And so there are a few questions on those assessment tool, ESG risk assessment tools on client protection, and financial service provider can find support signing on client protection pathway. So that's for the basic social standards that are reported and tracked. And we have, for this, we have some benchmark because we have a long-term history on those practices. So we know what is good practice, average practice or bad practices. So on the social side also, what we have discussed with the financial service provider and the investors is that we have also a lot of data, existing data, in the management information system of the provider, that if they are disaggregated by gender, for example, it is a good point and a good analysis in terms of ESG risk. We have some example from financial service provider in ECA, where just with existing data on the MIS, they have seen, for example, that they have a high number of loans for women. Women made 60% of the loans, but average loan size is 50% the loan size given to men. So yes, they are reaching women, but with smaller loan amounts. And when they disaggregate the portfolio at risk by gender, they see that there is a better quality of portfolio for women with a PAR 30, for example, of 1.5 against 2.2 for the men. So this basic calculation of portfolio at risk by gender is something that becomes also standard, and it's quite easy for most of the financial service provider. And that help also understanding what are the challenges or how to support better by type of client. So it can be men, women, but it can be also by age. We see young people, for example, having a portfolio at risk, which is higher, so they need a little bit more support. And sometimes also on the surveys that the financial service provider can do on their clients, there is some question on repayment issue. Do you feel that the repayment is a burden? If yes, how did you manage it? And we see, for example, on this specific example from the financial service provider that we were working with, that 41% of women said they discussed with the FSP repayment schedule versus 15% of men. So disaggregating the results by gender show also some stories showing here, for example, strong relation of trust between the financial service provider and its women customers. So that's something that can help reporting when you have to report on data disaggregated by gender, for example, but that helps also in terms of risk management. They have also seen that the women had less profitable business, so they needed further support. So that's also drawing the relationship with the clients, the type of support that you provide. You have trust and good relation with the women, but maybe you need to support them a little bit more on non-financial services to make their business more profitable. You have better quality of portfolio for women. So those use of existing data from your MIS is also something that helps ESG reporting, but also social risk management. So that was one example that we wanted to share with you. In terms of social, in terms of human resources, decent work condition, gender equality, what is requested from the financial service provider and their investors is to understand the decent work condition for their staff. So this is defined by International Labour Organization, and it has been fully adopted in the dimension 5 of the universal standards by all the social audit tools that you have been designed with ILO. So you can test and work as a financial service provider or as an investor in due diligence and monitoring, transparent human resource policies and contract, health and safety, staff representatives, avoiding child or forced labor, gender equality, adequate pay, etc. So this is in terms of practices, what has been put in place and how can you confirm as a financial service provider that you are in line with those decent work conditions. And now what is quite new for us in the financial inclusion sector and driven by the regulation on ESG and the SFDR regulation, we are now calculating gender pay gap. That's quite new, we didn't have, but the nice part is that benchmark already exists at the OECD level, for example. So we have some idea of what is reasonable, not reasonable. And how do we work on this? We have a simplified way. The ESG or SFDR regulation is talking about average all gross hourly earnings. We are just taking on average, okay, what is the number of staff, number of women, number of men? What is the total payroll? And the only fancy data that we ask is what is the woman payroll? So you need to have a MIS or a way to differentiate what you have paid for men, what you have paid for women. But once you have this, you can calculate gender pay gap with the average gross earning for male minus the average gross earning for female over the average gross earning for male. So this is quite simple. It's not compulsory. You see, there is no red star in front of the payroll. It's not compulsory on the assessment tools, but if you want to report on SFDR and if you are requested to report on SFDR, and if you want to work on gender pay gap and equality, you can use those tools to calculate. I have shared with you 3 examples. One financial service provider with 215, it's real examples, but we have anonymized. One with 215 men staff, 163 women staff. Total payroll, I won't give the figures, but when we calculate the gender pay gap with the calculation described above, we have a plus 40% gender pay gap. So huge gender pay gap. The second one, which is a larger one with 5,000 plus men staff. This one is quite good. They have just they are even a minus gender pay gap, but minus 0.3. And that's a real case. Huh? I did not invite this one, but this one is with a 0 gender pay gap, the third one. And what do we do with that? What does it mean? On our first case, okay, there is a very important gender pay gap. I think the average on the OECD benchmark is around 30%. Maybe a little bit less, maybe 30 is the maximum. I'll check. I'll share with you the link with the OECD gender pay gap benchmark. But at least it gives you an idea. Whatever, 40% gender pay gap is huge. It means that on average, your women staff are paid 40% less than your men staff. So you should check your salary scales for women. You can help internal promotion. You see that you have something to do. On the second FSP, we say, oh yes, minus 0.3, that's great. But then when you calculate the number of women staff, they are only 3%. So, okay, they are paid as much as the men, but they are only 3%. It was 170 women out of 5,500 men staff. So in this case, okay, that's nice. You have no difference for the women, but you could increase women workforce. Specifically on this organization, they have almost 100% women borrowers. So there is a huge discrepancy between women workforce and women clients. And finally, our third case is a great case, a great neutral gender pay gap with a balanced workforce. And it's a good example for the financial service provider. We have tested also with this organization how far they are going to the dimension 5 of the universal standards. So they are also quite good on other aspects of decent work condition. So that's some guidance that can be provided also to the sector to improve gender equality at the staff level. I don't see the chat box, so Pavel, if there are some questions, do not hesitate to stop me. Huh?
Yes, not so far. So as
Okay.
soon as they come in, I will let you know.
Okay. Okay. And the last point that we wanted to share is on governance. So on the governance, on the ESG framework, there is a lot about good corporate governance. So we have added on the social audit tools some basic checks on good corporate governance, which is not necessarily linked to social performance as such. Do you have independent board members? Do you meet regularly? Do you have minutes from all the boards so that it's very clear? But there are also issues around gender on the SFDR framework. There is one principal adverse impact on gender board diversity. So for this, we have now some benchmarks. Here we have some data from SPI. In blue, we have women in board, in orange, women staff, in green, women manager by region. So on average, we have about 30% women at the board level, which is not so bad. Not yet equity, but at least 30%. We see that, for example, it's a little bit less, 0.20 or 27% in European and Central Asia. Just food for thought for our partners here to maybe increase a little bit the representation of women at the board level. Women staff and women manager, but the information that will be required for SFDR reporting or ESG is the blue point on women at board. But that's nice also to have some types of benchmarks so you can check as a financial service provider or at the portfolio level if you can push a little bit for women representation at the board level. And last time I had shared some examples of funds that have been comparing their own results at the portfolio level. So against, I don't have the. I think the fund is the red one, but in this case, the SPI database on comparing an equivalent portfolio of the fund was 24% on women on board, and they had 30% on their own database, so that was not so bad. But in this case, it was more on women in management. It was 32% on the Cerise+SPTF database against 25% at the fund level. So in this case, the fund has decided to focus its technical assistance support on gender-specific HR policies to promote a little bit more women in management, because compared to the benchmark, they were below the benchmark. So that's our examples also on how ESG reporting can be used not just as reporting and ticking box, but also to provide support to the organization to improve social and environmental and governance risk management. So yeah, those are the concrete examples, and let's continue. We know that SFDR is raising a lot of discussion in those days, plenty of questions, not yet very clear. Some change to come maybe in 2025, but for now we can continue to make sure that ESG reporting makes sense for the financial service provider and for the investor also.
Okay, thank you. Yeah. Okay, thank you, Cecile. Yeah, and I confirm, and we will make sure that in the presentation we will share with participants, we will add these lines. And you were right, the font was represented by the red line. So we have a question from Babukar. Is the gender gap calculated position by position?
No, it's a very, very basic calculation. But if you see the definition also on the SFDR, Sustainable Finance Disclosure Regulation at the EU level, it's really not taking into account the position. So of course, if you are more women in management compared to men, you will reduce the gender pay gap. but it's not necessarily linked to the difference in salary scales. But it's simple to calculate. As I showed you, you just ask number of staff, number of women, number of men, and total payroll, women payroll, and you have already food for thought. So if you see that there is a huge gender pay gap, you can check. You have on the SPI online tools, for example, the number of women in management, the number of women staff. On the example that I shared, okay, the gender pay gap was almost 0, but there was only 3% of women. So you can still raise discussion within the organization on what should be done and what can be changed. But the calculation is very basic. If you want to dig a little bit further, of course, you can calculate gender pay gap by position. But for now, it's a global calculation aligned with SFDR and ESG reporting.
Okay, we have Isabella asking, to enter our arena with her question. So please, Isabella, go ahead.
Yes, I have a sort of more general question. As over years in microfinance, at least in Central Eastern Europe, for different MFIs, the number of loans to women has been a challenge, and the number of women on the staff sometimes is a challenge. And in terms of the number of loans to women, is that some MFIs only make loans to businesses or entrepreneurs, and statistically, let's say the percentage of men and women entrepreneurs is like 60 to 40, or in some countries maybe even lower, or especially regarding farmers. So as clients are really accepted, as applications come, it's really difficult to have very good relation between those loans to men and women. And so I wonder what would be a possible, I mean, obviously it's possible to have special programs for women, but it does not always provide sufficient encouragement. And also regarding staffing, especially for loan officers. So basically, we have seen MFIs that have a lot of, I mean, the majority women on staff and management positions, and partly because actually this type of job is perceived as a job for women, and men are so maybe interested and women are interested. In other cases, we see that women simply do not want to be loan officers and go to the field and so go in the mud and talk to farmers. So what would be your advice for such MFIs, how to, let's say, comment or approach those challenges?
Thank you, Isa.
Yeah, thank you, Isabella. I think it's a huge question, and I think it's why it has deserved a Nobel Prize in economics this year. So it's still work in progress, and still lots of work to be done. In general, what is advised is, okay, you have a current situation. What can be your next target? Be reasonable. Try to push a little bit your women staff, your women clients, accompany them, as we have seen, for example, on the case that we shared, smaller loans for the women. How can you help them having larger loans, but also less profitable businesses? So how can you accompany them to have profitable businesses? In some countries, not necessarily Eastern and Central Asia, but in Southeast Asia, for example, there are lots of women clients, but they are not using the loans. So also tracking who is taking the loan, who is actually using the loan, to make sure that women are empowered to use the loans, and not just the passing through for their husband or brother or father. But it's also, as you say, a little bit of cultural change, support step by step, sharing lessons from different, adapting products and services to make sure that it fits the women needs and preferences. So it's a process. Huh? We don't say that it's a easy way, but also having benchmarks and data help also to say, okay, are we really far away from what we could do in our region, or we could do with the type of organization we are? Or are we already quite good because we have 40% of women in board or women in management, and it's above the local benchmark, for example. So it's also, being positive sometimes when efforts have been done, and it's not yet parity, but it's better than the average in the region, for example. So yeah, lots of question and discussion, and we can follow up on this also.
Okay.
At least we have transparency on data now, more transparency on data.
Okay, thank you, Cecile. We have a question on SPI. Is the information submitted to SPI available for all to see, to the public, or only to designated approved entities?
Yeah, the database is not available. It's confidential data. But when you have an account on SPI, you will be able to get access to basic benchmarks. So we share basic benchmark. We are also preparing a state of practice where we summarize those type of lessons. But we receive the data on a confidential basis. Then the financial service provider or the investors doing the audits or the consultant doing the audits can share with the authorization of the financial service provider the data with others. So there are some sharing options. And yeah, global benchmark are available for free. But we have changed, it was previous standards, new standards have been launched. So now we are in SPI 5. So we are in the transition period where we have to recalculate the old benchmark. So for now, just contact us directly if you need some benchmark, but soon they will be available also.
Okay, thank you. I don't see any other questions in chat. Anybody would like to come up with their question on camera? Not yet, but
I shared some
perhaps
guidance. Mariela?
I only want to, we are from BIP, we are investor side. I only want to add that if you provide us data as microfinance institutions, we will not publish the data. So individually, we will aggregate. So we will show only from our portfolio the data. So like the data will be not public for our supervisory entities.
Okay.
And each audit comes with a level of authorization. So each financial service provider or investor can decide if the data is just stored on SPI Online database, because to be used, it has to be stored, but not used for anything. If it can be used for benchmark. But then we at Cerise level verify the quality of the audit to see whether they can enter the benchmark or not. If the quality is not good, we don't use them for the benchmark. So we have good quality benchmarks. And then it can be shared. There is level of authorization also to share with Atlas. Atlas is a sector database for financial, social, and context data, APR also on the pricing. And they help also to make the link with the SFDR calculation and proxy providers and so on and so forth. So we have different levels of authorization, but of course it's up to the financial service provider how far they want to share the information. And we don't, as Mariela and as the investor, we don't share individual data.
Okay, since I don't see any further questions in chat, let me wrap up. It was an interesting webinar, and thank you also all the participants who engage in the interactions, discussions with their questions, with their comments. It seems that this topic is really of interest to quite a number of people. So I would again encourage you, when you leave the webinar, and you fill in the survey, please feel free to mention any specific topics which could be taken out of this whole ESG big subject, and we could focus maybe on some specific issues, and again share with you good presentations with good speakers, which are, as Cecile, as Taras, you see, they are very skilled, very experienced, and they are able to deliver really grateful and valuable insights. So thank you very much to both of our speakers. Thanks a lot for your involvement, for your preparations, and hopefully we see each other in one of the next sessions, and wish all of you a very good afternoon or evening, wherever you are located. So thank you very much for your participation, and see you around.